Now, John Lewis, the best-known employee-owned business in the UK, has been through hard times recently. But new research from the Employers Ownership Association and the Ownership at Work think tank suggests that companies that are owned by their staff are up to 12% more productive. It suggests that while employing just 0.7% of workers in the UK, they drive between 1.7 and 2.1% of overall economic activity, equating to £37 billion. Well, joining me now are Campbell MacDonald, Chief Executive of Ownership at Work, and Neil Wright, Managing Director of Tenscare. Welcome to you both. Welcome back to you, Neil. Campbell, let me start with you. Why do you think that employee-owned businesses are more productive?
Well, the research we've done suggests that part of it is because the way in which the business makes decisions is different. And that involves choosing to look after their employees better, whether it's health and well-being, whether it's training and development, whether it's paying a higher basic wage to those on the lowest end of the income scale. They put twice as much in bonus and profit into the hands of those employees. And whilst we can't claim that you do one thing and it automatically delivers the other, the data suggests that these businesses do it, and when you compare them to similar non-employee-owned businesses, the results are pretty powerful and pretty stark.
OK, well, Neil, how do you think you benefit from being employee-owned?
Sure, yeah, we've been employee-owned now for 6 years, but we're a business that's 30 years old, and the research resonates with us as we've seen our business treble in turnover in the last 6 years. We've won the Queen's Award for International Trade. It's been a massive impact on us, and I think, actually, it comes back to a little bit of what the magic sauce, what makes an employee-owned business work. It's actually, I think employee-owned businesses tend to focus on the people. It's much more people-centric, so we're very purpose-driven. Our values are caring, cooperation, encouragement, togetherness, which are all things that are never talked about at a business school. You know, at business school, it's about accountability, measurement, responsibilities, and actually, it's the people that drive a business. If you get that right, it's the classic Peter Drucker, you know, sort of culture eats strategy for breakfast, and that's sort of really what drives employee-owned businesses.
But as CEO, do you ever feel that your hands are tied because you might have to run a contentious decision past a load of people rather than being able to say, right, we're doing this?
It's actually, it doesn't work as a cooperative. It does work as a board of directors and driving the business that way, but the employees have a voice in that. And one of the bits of research that has come through from the Knowledge Programme is about how much money is put into research and development. Now, when we were looking at research and development, we obviously deal in electrotherapy, but we're very interested in looking at light therapy and the therapeutic benefits of that on neurodegenerative diseases such as Alzheimer's. Now, that is a massive investment of resource, and that takes away from paying a bonus and a dividend to the employees because they're the beneficiaries of the employee-owned trust. But actually, today's generation, they want to be making a difference. It's not all about the paycheck. It's about having purpose. They know that even if we only make a modest contribution into the science of that, they will feel better about it in themselves. And I think it's a culture of EO and a characteristic of EO businesses to be a bit like that.
OK, well, that's a good example of where the model works. But what about a business like John Lewis? It's in an incredible bind. It can't raise capital because its owners, the employees, don't have the resources to be able to do that. So it can't go to outside shareholders.
So, look, I can't speak on behalf of the John Lewis Partnership, obviously, Ian. They were sponsors of our research, and I think that a lot of what we found resonates quite powerfully with their partners in their branches. But look, we've talked a lot about what these businesses do for their employees. But let's be clear, we also found that employee-owned businesses tend to be more profitable. They are recruiting more people. They're investing more, as Neil suggests, in research and development, in improving products and services and so on, compared to non-employee-owned businesses. So, look, John Lewis Partnership is the most famous employee-owned business in the country, but there are close to 1,700 employee-owned businesses in the country. There are lots of other great names doing fantastic, high-performing work out there. So, the retail sector has its own particular challenges. And I think that's where John Lewis are wrestling with those at the moment. The model is incredibly flexible.
OK. Well, Neil, look, while we have you, how are you trading at the moment? And are you concerned by these potential issues in the Red Sea that are causing freight to be disrupted?
Well, we obviously have a distributor in Israel, and that's massively impacted them. So we're concerned more for their well-being. The business will survive, with the disruptions of, sort of logistics. So no, we're managing to manage it. As we've seen lots of other economic and political upset around the world over the last 24 months, we've managed to sort of work our way through that. And there's a collective recognition of that in terms of in the business. We're about actually looking after each other and encouraging each other and caring for each other. So that works. And what I would say to the John Lewis not being able to go out and raise funds, shame on the banks if that is the case, because actually the research says that the businesses are more sustainable, they are more profitable, they are more productive, and the banks need to. It's a bit like in the small business sector about lending from banks as well.
All right. Love to carry on the conversation. We're out of time, I'm afraid, though. Neil
really
Campbell, good to see you both. Thank you.
Happy Christmas.
Now, tracking and monitoring wildlife in Africa's game reserves is crucial to the survival of endangered species such as the rhino. Based in Rwanda, Ampersand was the first company to put electric motorcycles on the ground in Africa in May 2019, enabling people to travel cheaply and cleanly. The company has just raised $19.5 million in funding, partly to ramp up production of its electric motorcycle batteries. I've been speaking to Josh Whale, he's chief executive and founder of Ampersand, and to Luke Davey, he's field operations manager at Akagera National Park in Rwanda. I began by asking Josh what he was going to do with the money raised.
So both on R&D and expanding our fleet of electric motorcycles across Kenya and Rwanda and in more countries as well. There's still a lot of very exciting R&D work that we're doing around the battery, the software system that manages a fleet of batteries in real time, and then our network of swapping stations where customers can come in with an electric motorbike and get a battery swap that costs far less than fuel to keep them moving.
For those not familiar with it, explain briefly how the technology works.
So basically, we have a proprietary battery pack that we've developed to be cheaper per kilometer and very reliable, quite different from typical electric two-wheeler, scooter, motorcycle batteries in that normally that are built for commuters and for the recreational market. And so what we do is we have a network of battery swapping stations where a driver can come in and they can get a swap in about 2 minutes, and then they get back out on the road again. So everything is constructed and really set up so that the African commercial use motorbikes, the taxis and deliveries that make up half of all the road fleet in sub-Saharan Africa are able to do what they've always done, just that it costs less to buy the bike and it costs especially less to operate and power it.
And what was it about Rwanda that made you want to launch there?
So we really looked around for where we could put a vehicle on the road that was simply cheaper and better from day one. And we were sort of shopping for unit economics, if you like. So we really looked at where were there lots and lots of vehicles, quite densely concentrated. So lots and lots, so 60% in Kigali in particular of all the road traffic are these motorbikes, and where they're spending a lot of money on fuel every day. And then finally, where that savings that we could offer them, we save about 35% for our customers on their fuel cost, also represents a really big difference for those customers. So by saving 35% on their running costs, our customers actually double their take-home income at the end of the day. And we see that very much translated into school fees paid, cement floors on homes instead of dirt floors, and really just breaking out of the poverty cycle.
Well, Luke, let me bring you in. Now, you're partnering at the National Park with Ampersand. What will this partnership bring for you?
So the primary cost driver here is cost reduction. And what we're looking at is what's the most effective tool to get the job done? How can we get increased mobility into the field for our teams across the range of community engagement officers, law enforcement officers, operations officers, all of these guys to get their job done in the most cost-effective manner with the best tool for the job.
And also, presumably, this is more environmentally friendly than people whizzing around on bikes powered by petrol engines?
Absolutely. I mean, there's the impact of burning the fuel, but also in our case, there's also the impact of transporting that fuel to another place to be burnt in another place. And so that you sort of have compounding impacts there. And so reducing the need to transport fuel into remote areas is a huge cost saver, reducing the overall demand for fuel. And then from an environmental perspective, the amount of fuel that you're burning on a daily basis, all of these things have hugely compound effects on the environment.
And what have visitor numbers been like at the park lately?
Significant. We've had a very, very good recovery from COVID. This year has been our best ever since the African Akagera Management Company has been founded in 2010, and it's been a very, very successful year for the Rwandan government and for the Rwandan country from a tourism perspective as well.
So, Josh, as you mentioned just now, you're in Kenya now as well as Rwanda. What are going to be the challenges in rolling out the service there?
The economics are different. What we find in Nairobi, where we have currently around 300 motorbikes on the road, is that it's more, larger cities are more segmented, different uses spread out across the city. So diving in and really understanding the different use cases for different customers is really important. But as a market, Kenya is about 15 times the size of Rwanda, but more diverse, more challenging. Rwanda's been a fantastic place for us to develop the technology and launch it. And also the collaboration with Akagera means that we're able to really stress test our hardware in a really challenging environment. So dirt roads where they're really put through their paces means we have an accelerated development timeline. So we'd be able to go through generations of vehicles in just a few months because our R&D, our engineering team are all on the ground only 3 hours away in Kigali.
And what sort of potential do you think there is for rolling out these e-mobility solutions across the African continent?
So currently, roughly half of all the motorbikes in sub-Saharan Africa, so about 25% of the total road fleet, fall within a market that we can fall within effectively a serviceable addressable market. So where we can earn at least a 20% gross margin and at the same time also save customers at least 15% of their operating costs. But for the most part, actually quite a lot more than that. There are still countries, most notably Nigeria, where the cost of fuel is still quite low, despite the removal of fuel subsidies, where it's currently borderline, but with improving policy, improving pressure on climate change, and I think just the proof that we've now provided, we're covering 1.4 million kilometers every week, and so we're really seeing uptake from governments across the continent saying, "Hang on a minute, we don't need to subsidize fuel anymore. We've got something here that's cheaper and better, and just happens to be electric."
Just a reminder of the breaking news this hour. At least 11 people, including the gunman, have been killed in a shooting in central Prague. Another 30 people have been injured, including 9 seriously wounded, according to the Czech Rescue Services. Police previously said the gunman had been eliminated. More on that throughout the afternoon here on Sky News. After the break, we'll have the markets. Don't go away.
I'm Adam Parsons. I'm Sky's Europe correspondent based here in Brussels. Obviously have been pulled up out and are being used as missiles to hurl at these police. Made by people who dare to challenge. Nice to see you again, Mr. Barnier. Why?
Meeting you.
Fishing does have the potential to stymie an enormous economic deal. We take you to the heart of stories that shape our world. What strikes you when you come to this glacier is not just the way in which the environment is changing, but the speed at which those changes are happening.
It's like Emirates. It's like better. Fly Emirates. Fly better. Thank you.
Well, European stocks have traded to the downside today following last night's sell-off on Wall Street. Here's how things have finished in continental Europe. Here in London, the FTSE 100 also finished to the downside in a broad-based sell-off of 0.25%. Burberry was the leading blue-chip faller amid ongoing concern over the luxury goods sector. A clutch of stocks went ex-dividend today, in other words, trading for the first time without the rights to the latest payout. They include British American Tobacco, Halma and United Utilities. That's why all of those are lower. Vodafone is one of the gainers this afternoon. That's on reports that Swisscom is considering bidding for its Italian business. Outside the FTSE, the standout performer is the North Sea oil producer Harbour Energy, which is up 28%. That's after it struck an $11.2 billion deal to buy the non-Russian oil and gas assets of the German oil and gas producer Wintershall Dea. Up 28% there, extraordinary jump there. Over on Wall Street, US equities have rebounded at the open. The chip maker Micron has risen by 7% after last night's trading update went down well. But Warner Brothers Discovery and Paramount are off 4.75% and 1.5% respectively over news of their putative merger talks leaking. On the foreign exchange markets, pretty quiet ahead of tomorrow's inflation data from the US. Pound up 1/5% against the dollar, off by 1/4% nearly against the euro. Single currency up nearly 0.5% right now against the greenback. After 3 consecutive days of gains, the oil price has taken a bit of a breather today. A barrel of Brent crude currently changing hands at $78.92 a barrel. That's off 1% on the session. Joining me now is Sue Nofke, head of UK equities at Schroeder. Sue, great to see you. Very strange events on Wall Street. Big sell-off overnight. Quite the worst for some while. And yet we've had a rebound this afternoon.
That's right. We have travelled very fast in quite a short period of time. So from the lows towards the end of October, it's kind of been one way. And we haven't had sell-offs or moves of less than a fall of more than 1% for some time. Normally, those would be taken as normal. Yeah. But because we haven't had one for some time, it shook people up. Yeah. And we've been enjoying a bit of a Santa rally.
We have. Do you think that Santa rally is concluded now?
Well, we don't have many trading days left, no. But the data has been all supportive. The economic data, the inflation data, the employment data, it's been soft enough, not enough to give pause for concern about a recession, but enough to feel that central banks are going to cut rates in 2024.
Yeah, I mean, that's been the big driver. Are markets getting carried away?
Maybe, but the markets have been on it better than central banks talking about the plateau, Table Mountain, not the Matterhorn. And actually, it looks like after that big steep rise in interest rates we've seen in the last 2 years broadly, we might be coming off the top of the mountain quite quickly in 2024.
But what does it mean, though, if we don't get rate cuts of the order that the markets is expecting? Does that...
We could see a disappointment in markets because everything has been rebased upwards as a result of that softer data and bond yields leading all the comments from central banks.
Now, obviously, you run a number of income funds here. Are you still finding sufficiently attractive valuations for the sort of stocks that you're looking for?
I do in UK equities. I think it's a standout market from a valuation point of view and an income point of view. So perhaps investors will look more to the UK than they have hitherto done. We've seen a broadening out in this everything rally from just the Magnificent Seven, which was so dominant earlier this year, to other things, other asset classes and other markets.
The Magnificent Seven, it's a good point you raised there. There's a great piece in the Wall Street Journal yesterday that pointed out the Magnificent Seven are up 75% this year. The other 493 stocks in the S&P are up by just 12%. Can this tech rally continue?
It could. They're fantastic companies and it's very difficult to dent them. But trees don't grow to the sky, as one of my colleagues talks about. And I think there is an opportunity for other stocks, other sectors, other markets to participate. Normally, when we get more comfortable with inflation easing and bond yields coming back from the highs that we've seen earlier this year, that allows everyone else to breathe and it broadens out the participation. And we've started to see that in the last few weeks.
OK, which are the sectors that you're looking at then in that respect?
Well, lots of interest rate sensitives, I would say. Property, utilities, anything that borrows quite a lot, where refinancing risk is actually less scary going forward. And that would include house builders and house-related stocks as well, anything with quite a lot of debt. But broadly, most things benefit, consumer benefits, because employment data is holding up quite well. With inflation easing, the wage rises will actually stick in your pocket. And so consumer spending might surprise to the upside in 2024 in the same way as it has in 2023.
That's a nice positive note on which to end. Sue, it's lovely to have you in the studio. We haven't had you on the programme for a while. Have a great Christmas. Thank you.
Thank you.
That's it from me. I'm back again with Business Live tomorrow morning at 11:30. Hope very much that you'll be able to join me for that. We get some GDP revisions potentially tomorrow. It could be very interesting in the markets. That's certainly something I'm going to be talking about very early from tomorrow morning here on Sky News. Hope you can join me for that. In the meantime, stay tuned. Up next, it's Mark Austin with the News Hour. Cheerio.